The world economy is being balanced on a knife's edge. You may have heard whispers about a coming crash, but this time, it's different. Experts, billionaires, and Wall Street titans are all warning of a crisis like we've never seen before. Stick with me until the end because I'll reveal what's coming and what you can do now to prepare. Trust me, you won't want to miss this. We're hearing warnings from the top minds across industries. These aren't just commentators. They're leaders who run billion-dollar companies, manage enormous funds, and have unparalleled access to data. They're not just predicting, they're preparing. Jamie Dimon, the CEO of JP Chase, running the largest bank in America. If anyone knows how vulnerable the economy is, it's him. He recently shared that the Federal Reserve only has a 33% chance of avoiding the recession. So what does that mean? That implies a staggering 66% chance that we're heading straight into a recession. That's a significant concern based on what Jamie Dimon has laid out. He's not the only one sounding the alarm, though. Elon Musk, visionary, innovator, and one of the world's wealthiest individuals. When Musk speaks, people pay attention. Recently, on Twitter, a user asked Musk if he still thinks a recession is on the horizon. Musk didn't hold back. He's not just predicting a downturn. He's calling it a necessary wake-up call. According to him, it has been raining money on fools for too long, and some bankruptcies need to happen. Musk also highlighted how the COVID stay-at-home era led many to believe that hard work isn't essential. But he warns, a rude awakening is coming, and it's time for companies and individuals alike to brace for the impact. Carl Icahn, a man practically synonymous with Wall Street and legendary for his investment insights. Icahn himself has publicly stated that he sees a recession coming, possibly even something worse. Now, why would a figure like Icahn, with billions on the line, publicly say something like that? Think about it. This is someone who stands to lose in a downturn, yet he's sharing a cautious outlook. Perhaps he's already making moves to protect his portfolio. But still, if Icahn sees risk, it's wise to pay attention. And then there's Leon Cooperman, a titan in the investment world. Just over 68 weeks ago, he shared his thoughts on a podcast. Worth an impressive $2.5 billion, Cooperman stated that he is anticipating a 40% market correction. He didn't say this lightly. He's been in the game for over 48 years and has witnessed market cycles time and time again. This isn't a prediction from someone who is in business for 3 or 4 years. It's from someone who's seen the ups and downs of the market repeatedly for over 48 years. And the most important thing to notice is that a recently published Forbes article is saying that over 75% of Fortune 500 CEOs are expressing concerns or preparing for an impending recession. When over 75% of Fortune 500 CEOs express concerns about an impending recession, it's not something we could take lightly. These CEOs control the economy, the workforce, and huge parts of the market. They're cutting costs, building cash reserves, and preparing for what's coming. This isn't fear-mongering, it's survival strategy. We're not just listening to guesses here. These warnings are grounded in data. Now, let's clarify something. This isn't your typical recession talk. A recession is bad enough, yes, but a crash? That's a whole different story. Think of a recession as a slow, creeping illness, whereas a crash is a sudden, violent heart attack. The impact of COVID-19, high inflation rates, and geopolitical tensions have created a fragile economic environment. These aren't isolated problems. Imagine a dam with several small cracks. One by one, they don't seem too threatening, but together, they're a recipe for disaster. Global debt is at an all-time high, consumer spending is slowing, and with an aging population, fewer people are in the workforce to drive growth. This perfect storm is building, and multiple economic indicators are showing signs of strain. These trends affect every dollar you spend, invest, and save. Now, I'll break down what history tells us about crashes like these, and how you can actually turn this looming disaster into an opportunity. History shows that every major crash has clear warning signs. Let's look at the Great Depression in 1929, the dot-com bubble in 2000, and the 2008 financial crisis. In each case, there were indicators: overpriced assets, excessive debt, and unsustainable growth. But most people ignored them, thinking the worst wouldn't happen. Warren Buffett, often called the Oracle of Omaha, has weathered every major crash for the past 82 years. His famous mantra, "Be fearful when others are greedy, and greedy when others are fearful." Buffett didn't panic in these crashes. He saw opportunity. And here's where it gets interesting. If you stay with me, I'll show you exactly how to prepare yourself like Buffett, turning fear into fortune when the time comes. In every crash, assets go on sale. During the 2008 crisis, while millions were losing everything, the smart investors saw once-in-a-lifetime deals. Imagine walking into a store where luxury items were marked down by 90%. You'd probably go all in, right? This is the same idea, only it's about making smart financial moves. This isn't just about avoiding losses. It's about potentially turning this crash into your big chance. Here's a hard truth. Recessions aren't just painful, they're necessary. Imagine the economy as a dense forest. Sometimes, wildfires are needed to clear out the deadwood and make space for new growth. In the same way, recessions clear out inefficiencies. Weak companies fall, while strong ones adapt and rise. This is your chance to shed financial habits that aren't working, streamline your own investments, and prepare for a future where only the fittest survive. How can you make sure you're on the right side of this? I'll share 3 practical steps even the pros follow to stay safe and thrive during a downturn. Let's get right into what you can do today to protect yourself. First, build up cash reserves. Aim for 6 months' worth of expenses in liquid cash. In a downturn, cash gives you power. It lets you act quickly when others can't. Second, diversify and adjust your investments. Look for safer, more stable options that hold value in bear markets. And finally, stay informed. Staying updated with reliable information is crucial. In a volatile market, things change quickly, and being one step behind could cost you. But how do you know what information to trust? Follow what experienced investors and analysts are doing. They're the ones who've been through crashes before, and they can offer valuable insights on where to put your money or pull it out. And of course, don't get swayed by hype. Let's talk about inflation, a silent force that's eroding the value of your money every day. Imagine you have $100 in your wallet. With rising inflation, that same $100 will buy you less and less each year. And here's the real thing. During economic downturns, inflation can actually spike before stabilizing. It's a double-edged sword. As prices go up, people and businesses start cutting back on spending. This leads to slower economic growth, which only worsens the downturn. This is why financial experts like Warren Buffett emphasize owning assets that keep up with inflation, like real estate or stocks in companies with pricing power, companies that can raise prices without losing customers. Inflation protection is one of those areas you can't ignore in times like this. The crash we're talking about isn't just limited to one country. It's a global phenomenon. If you think it's only the US or European economies at risk, think again. China's debt crisis, Europe's energy struggles, and the ongoing geopolitical tensions are all interconnected. When one major economy stumbles, others feel the impact. We saw this with the 2008 crisis. What started with US mortgage lending spiraled into a global recession. Geopolitical experts are now saying that this next downturn could lead to a domino effect, impacting markets worldwide, from emerging economies to developed nations. So, don't just watch your local market. Pay attention to what's happening internationally. Real estate has traditionally been considered a safe haven during downturns. But here's the thing, times have changed. High interest rates and rising costs have created a situation where real estate prices are actually overvalued in many markets. In some places, we're seeing prices at levels not supported by income growth or economic fundamentals. Investors who think real estate will always rise could be in for a rude awakening. Experts like Robert Shiller have noted that the current housing market exhibits some unsettling similarities to the 2008 bubble. Shiller cautions that while real estate may retain its value over the long term, there is a risk of notable declines in the short to medium term. If you have investments in real estate, it might be prudent to reassess your position. This doesn't necessarily mean selling everything, but it's wise to carefully consider your exposure. Let's discuss tech stocks. They've been on a wild ride over the last decade, and some people think they're a safe bet even in a downturn. Cathie Wood, CEO of ARK Invest, believes that while traditional tech might suffer, emerging fields like AI, biotech, and renewable energy will continue to grow. So, not all tech is risky, some sectors might even thrive. So if you're holding on to tech stocks, make sure you're diversified within the sector. Consider mixing traditional giants with emerging players to stay balanced. Here's the part where things get interesting. Every crisis brings opportunities, and those who are prepared can come out stronger. During the last major crash in 2008, many people lost money, but those who were ready saw it as a chance to invest in quality assets at a discount. As Warren Buffett says, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. One area that often performs well during downturns is precious metals. Gold and silver are traditional safe havens that tend to rise when other assets fall. They're not without risk, but they offer a level of stability during times of economic stress. On the other hand, emerging markets, as I mentioned earlier, can offer unique growth opportunities as they're less tied to the economic cycles of developed countries. But choose wisely, not all emerging markets are equal. And finally, look at assets tied to essential goods, things people can't live without, like food production, healthcare, and energy. These sectors are less likely to see demand plummet, even in a downturn. So, what can you do right now to recession-proof your finances? Start by cutting out unnecessary expenses. Build an emergency fund, even if it's just a few $100s at first. This gives you a safety net. Second, avoid high-interest debt like credit cards. If the economy worsens, having debt can become a heavy burden. Consider setting up a small, diversified portfolio. This doesn't mean you need to be rich to invest. Start small, but start now. Look for assets that won't crumble if the economy does, like bonds, inflation-protected securities, or even dividend-paying stocks. And lastly, keep an eye on cash reserves. Cash is king in downturns. These steps might sound simple, but they're the foundation of surviving any financial crisis. It's about being strategic, cautious, and disciplined. Now, a quick word on timing the market. Too many people try to guess the exact moment of a crash, thinking they can sell everything at the top and buy back at the bottom. But here's the truth. No one can time the market perfectly, not even the experts. The key is consistency. Regular, disciplined investing beats the stress and risk of trying to time everything. So, instead of worrying about when the crash will hit, focus on steady growth. Keep investing in small amounts and stick to your plan. This way, you're ready for whatever the market brings. All right, let's wrap up with the 3 key takeaways. First, stay diversified and focus on safe assets. Avoid putting all your eggs in one basket. Second, build your emergency fund. Cash reserves give you stability and options in tough times. And finally, keep learning and adapting. Economic conditions change fast, and the more informed you are, the better decisions you'll make. As I've shown today, this crash could be coming sooner than most people think, and the best time to prepare is now. Don't be one of those who ignore the warning signs only to regret it later. Instead, get proactive, get prepared, and make sure you're ready to turn this potential crisis into an opportunity. And since you've stuck around to the end of this video, it's clear that you found this topic intriguing. I think you'll definitely want to check out the videos popping up on your screen now. They explore even more fascinating finance topics that might just challenge your perspective. And if you enjoyed this video, make sure to like and subscribe for more videos that break down complex and foundational topics in finance. Thanks for watching.